Today, State Bank of India has revised savings bank interest rates. A two-tier structure has been introduced where the deposits up to 1 crore, the interest rate is 3.5%, and 1 crore and above is 4%. So there will be questions that about why and what is the rationale for revision in the interest rate. One major consideration is about the real interest rate. So what is the real interest rate and what is the nominal interest rate? Suppose the inflation rate is say 8% as an example, and savings bank interest rate is 4%, then your nominal interest rate is 4% and real interest rate is minus 4%. In fact, the depositors are not earning or gaining anything in real terms. But if the inflation rate, which is 1.5% as of now, and the savings bank interest rate is 4%, then there is a 2.5% gain every year, which is considered to be high. In last 6 months, State Bank has revised the term deposit interest rate 7 times. But now the scope for reducing further the interest rate on the term deposit has become very limited. And on a review of the whole situation, it was felt that the real interest rate on savings bank is currently very high. It has never been as high in the last 7 years, and therefore it was a time that the rate is revised and the real interest rate is brought to a more realistic level. Why are we paying 4% on the 1 crore and above balances? The main reason is that these are only institutional deposits. Individuals don't maintain that high balance, and these institutional deposits are kept by the state government departments. These funds are meant for the developmental activities, and it was considered prudent that we should continue to pay 4% interest rate on these deposits in the larger interest of the underprivileged sections of the society.